Everybody get ready to break your piggy bank because a miracle is happening. To the ones that's been hiding your money under the mattress or your savings account and have always wondered what is this phenomenon called the stock market, that if you invest in them, money would just start raining down from the sky. Or so you heard from your neighbor. Hi, my name is Yi and this video is about how to invest in the stock market in 2020. Let's go. As you obviously have heard, coronavirus is wreaking havoc in the world economy. This is caused by a myriad of reasons that causes the economy to fall like dominoes. The stock market then directly takes a hit, and as you know, the stock market has taken dips to levels that we have not seen since the 2008 Great Recession. Crypto recently took a hit as well, dropping more than 50% in a day, and that was from my portfolio as well. Having my portfolio being mostly comprising of stocks and crypto, you may ask, wow, Yi, you must be so devastated. However, the truth is I could not be more happy to see my portfolio drop more than 20% in the last 2 months. Let me explain. The US stock market indexes have averaged about 8 to 10% compounded annual growth in its history. This means that a guy named Larry, without knowing that he's buying an index fund at its peak in 2007, right here, would soon lose more than 50% of the value in his portfolio in just a year. Right over here. Most investors wouldn't wait for their portfolio to drop more than 50%, but would have already cut their losses when it drops 10, 20 or 30%, maybe rarely 40%. But I mean, it's really understandable to do so. Imagine having your entire year's worth of your salary flooding down the drain just like that. Anyone would be frightened till they start foaming on the mouth. However, if Larry had a strong and rational mindset and kept his emotions at bay, and instead of pulling out his money when the tides turn and grab once in a lifetime opportunities in front of him and purchase more shares, basically if he just waited out for 10 years after the crash and bought in the dip when the market crashed, he would have gained returns that would double or triple the market averages of 8 to 10% that he initially wanted. Fear is like a virus itself. It's contagious. And when the whole economy is fearful, that's when investors start pulling out their money, and this process is followed exponentially till share prices start to see observable changes. And depending on the level of fear, share prices undergo massive corrections like what we are experiencing now. So for the most basic and sure way of investing to never lose money is number one, to invest long term. As you see, whatever goes down will come up eventually over the long run. And number two, to use dollar cost averaging. Dollar cost averaging is basically just putting in money into the stock market, into your portfolio, however great or bad the market conditions are. So for example, the S&P 500 index has been going up 8 to 10% a year, right? And as the market is generally moving up from here to here, let's say this is 1 year, 2 years, 3 years, 4 years, 5 years, right? So each year will be 8 to 10%. Alright? So the chances on your return on investment to be 8 to 10% a year, based on history, is not likely but definitely. If you bought into prices when it's low, right here, great, you got it at a discount and you're gonna earn more return on investment in the future. But what if you bought in when it's higher than right here, maybe here, 2 years later, 3 years later, let's say here? Regardless, in the long run, it still will average 8 to 10%. Like for example, this is, let's say, year 2030, alright? And it's already 10 years from today, okay? So if you bought in 2030, chances are in 2031, it's going to average 8 to 10% a year. So let's say if you put $1,000 in 2030, chances are you're going to earn $1,008. This method of investing is great because number one, it don't require any amount of time to learn how to invest. Just throw your money into your portfolio and let the tracking do its job and track the market to earn 8 to 10% a year. All you need to do is dedicate a few minutes each month to put the money into the brokerage account. Using this method avoids all emotional behavior, so it allows you to disregard however bad the market is doing, so you won't be scared, you won't suddenly, oh, go and sell. However, this only applies if the money that you're investing you don't have to use in the near future and is purely for investment purposes in the long run. If the market goes down 20% a day, what will you do? You will buy more. If the market rises 5 to 10% a day, buy more, great. Ultimately, I would suggest putting around 30% to 50% of your investable money in cash, so as to be able to buy into rare, super rare opportunities such as now. I want to end off saying that right now is not the end of the world, but try to think of it as the beginning. Think of it like this: the end of a bear run is always the start of a new bull market run. Do you complain if you go shopping and see the mattress that you want on discount? No, you'll probably fight over it with another guy that wants the same thing. So, be smart guys. Bye bye.